Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Tuesday, November 19th, 2019. We're another flat day, flattish day for the most part. Here's QQQ down 0.15%, so a virtual flat close. We'll start the video out, by the way. We'll just run through these index charts real quick, still watching the same trend lines, and also the sector ETFs. I want to get to that. The top sectors, the S&P 500, and then we'll wrap up with the futures, take another quick look at the VIX, and should keep the video short today. Alright, so zooming in here, again, the trend lines I'm referring to are off the October 3rd lows. We broke down the other day, last week, that is, very unimpulsively break down. We've been back testing from below. So that's how it looks on QQQ. And before I leave that chart, I want to point out one thing. Last week I had talked about a pending bearish PPO crossover. I went over some of the returns, and what you look at is the PPO histogram. Here's your PPO, works very similar to MACD. If you put up a MACD and a MACD histogram, you'll see almost the same thing here. And what I had pointed out back then, and we're still on watch for, is a PPO along with some type of sell signals. We had the breakdown, but again, unimpulsively in back testing. So last time we had a bearish cross on the PPO was right here, and that was right here before this. That was the last correction we had. One before that, that was a crossover was right here. And there it is. That was, and it also coincided with the divergent high. And just like now, market was up, resilient, new breakout to all-time highs. Bullishness got high, and then boom, you dropped. Within just I don't know, what is that? 1, 2, 3, 4 candlesticks. Was a drop of about, probably not far off what I'm looking right now on my my preferred pullback targets. That was about, no, that was actually more than that. Let me try to get over there. Yeah, I'm showing about an 8% drop, and again, I'll go over those pullback targets here. So you can see, that's what you look for, and you want to look for the bearish PPO crossovers, ideally in conjunction with other things such as divergence. And again, the more evidence you have when you're in a pretty resilient uptrend, the higher probability you'll get a sell signal that sticks. So that's it. So we're still pending that any type of reversal here and a break of those near-term levels, as well as that PPO crossover on I believe not just QQQ, if I'm not mistaken, SPY as well. We were looking at the same thing. Here's the PPO histogram. Yeah, there it is. So PPO is moving down, and remember, the PPO is a momentum indicator, and so what this shows you is simply when you see the histogram moving down, it means the PPO lines curling back down, and momentum is waning, and then you eventually get the crossovers, and as you can see, when you get the bearish crossovers, boom, each and every time. Recently we had a pretty decent correction. So these are the things I'm watching for, and until then, I know it seems like the market will never pull back or correct. I've talked about it many times. I don't see, this is just not my type of market. I don't see an objective entry. There's too many red flags for me to want to be long, nor is there a reason to be short this market at this point. At least not aggressively short for a pullback trade. All right, next one up would be small caps, IWM. We'll look at that real quick. IWM continues to stall out here around that 159.41. It's a pretty significant level. If you kind of strip away all these lines, we'll do that real quick. Remember, you have pretty much a sideways trading range. You had a V bottom right here into the December lows. Once that that initial snapback, markets are like a rubber band. They get very stretched. The more stretched they get, the more you snap back. And so, for the most part, this is the trading range throughout 2019 that we've been in. Pretty well defined. And so again, I've covered that. You can see it works with these micro trends. You get up to the top of the range, and then what you want to look for there are sell signals. Ideally, if you have divergence, all the better. It most likely indicates you're going to get a meaningful correction, especially negative divergence on the daily time frame. So we have pretty much divergence right there. Should have that marked. And we do have a bearish PPO crossover on IWM, but remember, the small caps are only going to go so far without the rest of the market. The large caps going down. So that's what you're looking at there. IWM at resistance, below trend line, the minor uptrend line right here, and this is a potential trend line. I should probably color that a little bit different. Why? Because it doesn't have a lot of reactions. It's one that I'm watching. I have one reaction here, two reactions there. a minor reaction there. And in my book, it takes at least 3 distinct reactions to validate a trend line. Any other 2 points can be connected at random. So we'll watch that. If we get a pullback and it kind of meshes with the more bullish of the scenarios that I'm looking for is just a pullback of maybe 3, 4, 5% at this point in the major indices, and a move back up. But again, most important is this resistance level. If I look at this chart, much more significant than that level right there. So let's see what happens with small caps and VIX. I want to talk about that. Not much new to update. Here's the level, these support zones, and I probably should color code these. I've been talking about them for weeks now. This is the support zone, which has really contained all pullbacks in the VIX in recent years, last couple of years. With VIX, this was record low volatility. Never ever before seen in history of the VIX have we ever reached levels such extreme low. So that was a period of unprecedented extended low volatility. This has been more closer to the historic norm. As I scroll back here, to 2014, you can see that has always been the bottom range of the VIX. And go to a weekly chart, and again, you can see it even longer term. We got down there. That was actually lower than back here in 2007, just before the market top there. So, all right. So back to where we are now. We're looking at the VIX, hovering just above the top of that support zone, such as it was here, and here. So really not really much of a change yet. You won't see the VIX move up sharply until the next correction begins, but that's something we're watching for. Okay, and about a week ago, I started making the case for a bounce in Treasury bonds and gold on the risk-off assets. The charts were confirming it. You had TLT, which is a long bond ETF, the 20 to 30-year Treasury bond, and that's what I have here on white. And as I've talked about, typically, but not always, you have an inverse correlation between the stock market. So the green and red candles is the S&P 500, and you can see here a very clear and unmistakable trend. When stocks are rising, Treasury bonds are falling. And when Treasury bonds rally, that's when stocks are falling. And you can see most of the inflection points, where the major turns come right around the same time. And from here, this is really the beginning of October. This is this big rally we've been on now. And Treasuries, as they usually do, were falling. You had a little spike up, and then they continue to fall. So this white line right here, and that's about a week ago. Again, it was technically induced. We had fallen back to long-term dual intersecting trendline support levels. And we've seen now a pretty clear trend. I've been talking about it recently, and I said, 1 day, 2 days doesn't make a trend, but we're going on about 8 trading days now, or about a week, or 8 days, 8 calendar days, and you see a clear and unmistakable trend of both stocks and Treasury bonds rally. So somebody's got it right, somebody's got it wrong. What I mean by that is smart money, they typically flock into Treasuries when they foresee, a weakness in equities coming. That's a flight to safety trade. Gold, again, as I've highlighted gold, silver, they've been rallying as well. And so this is just something to continue to monitor. It just means the longer you get these divergences, the more likely you are to get a mean reversion, meaning one of the two is going to happen. Either Treasuries, this could be, as I talked about, a technical bounce, because in that aspect, we hit that long-term support. But what should happen from here is if the market continues higher, I don't see a lot more upside before at least a decent correction. But if it does, that's certainly possible. Then you'll most likely see one of the two. Or now stocks correct, and Treasuries can either hold their own, or you get that resumption there. But either way, it is just, again, it's a one more of many red flags that you typically a healthy stock market rally will not have Treasury bonds rallying along with it. It just contradicts several things there, including not just the risk on risk off trade, but the reason that Treasury bonds will rally is diminished expectations for future economic growth. That's what is one thing that will cause Treasury bonds to rally, and they tend to sell off, as they did recently when recession fears abate. Okay, back to the indexes. You have, again, SPY breakdown. Back testing for just last couple days. SPY was down. I mentioned QQQ was up. slightly. SPY was down slightly. You call that a wash again. So for all intents and purposes, 0.3% down with the other one up, 0.15% or so. That's a flat day for the markets. And the other ones I wanted to show you real quick. Again, these the market is simply a sum of its parts, as I like to say. So as I started highlighting last week, in addition to those trend lines on the indexes on the October 3rd lows, which have broken but without any impulsive selling or really any solid, anything that looks like a real solid sell signal other than the break of support and back test, you have these trend lines. XLK, the largest sector in the S&P 500 by far, and the NASDAQ 100, and that one's still above trend. So we're going to watch all these trend lines, and when you start to see these crack, especially again impulsive, like I like to say, the redder the better. If you smash through there with a little red candle, you close just a hair below, and then again, let's say XLK does that. That is the most important by far, but you see XLV, healthcare, second largest sector, XLF, financials. But as I'm going through these, you can see these are all pretty well defined trend lines, and my guess is they will all, when you get some decent sell signals, they're all going to probably trigger within a day or two of each other, most likely, especially, if you look at these top four here, XLC being the fourth largest at, I haven't updated these in a little bit, but about 11%. And you can see, again, up above that pretty clean trend line there. Breakout right now, but like the broad market's not very impulsive and not really being confirmed on volume so far. So those are the levels I'm watching. We'll look at the futures and wrap this up. Okay, and the charts I'm watching I posted this morning, which, by the way, if you're a member of the site, I had to step away from my desk today. I was out for most of the day. I was out a little longer than I thought I'd be. So I'll work to catch up on post any questions in the comment section, trading room questions, chart requests. I'll try to get back to you guys as soon as possible on that. But before the markets open and the charts I'm watching, here's what I said. Pretty much a repeat of yesterday's 60-minute chart. NQ had set up in another small wedge pattern while backtesting the uptrend line. That same uptrend line, we're going to get to the chart in a second. And as I've been saying, NDX remains in an uptrend with sell signals to come on breaks below each of these support levels we're going to look at here, with a solid break below 8,200. I still think that is most likely the magic number, the one that will do the trick. If and when that happens, we'll likely begin to, any sell-off will likely begin to accelerate at that point. What I mean by that is you'll probably go from these 0.15, 0.5% down days to a 1% plus day. We haven't seen that in a long time with a little bit larger red candles. So that's there's the chart right there. That was again this morning. So yesterday, if you recall, we had this wedge right here. We broke down. We had an impulsive drop. Perfect kiss of that first support level that I had there at 82.66, bounced, came up, back tested again, and again, it's the same story. No marginal high. I didn't even bother extending the divergence lines, but you can see, they're still clearly intact. The divergence extended, and again, that was this morning. And let's look at what happened since then. We went on to break down. This is the updated chart. So just like yesterday, and this is, the technicals are working here, but you need to take out the more important support levels like that 8,200. So yesterday, when after that was posted, we broke down and we had the two biggest back-to-back most impulsive drop that we've had in weeks. And then look at today too. This morning, after that one was posted, that's that same trend line unmodified. In fact, when I zoom in like this, I could actually could have cleaned it up a little bit, and I'll do that right now. Tighten it up, in other words, right up to the bodies there. And that's how, when I draw these, they're kind of rough draws. If I zoom in like I did now, that comes in nice and clean. Well-defined trend line, breakdown, and two almost comparable candles to yesterday's candles. So that's it. That's what NQ looks like. And I know I sound like a broken record, but I see what I see. I report what I see. Nothing technically has changed now, other than the breakout to new highs not too long ago. From as far as the patterns here, the trend line, the breakdown, the divergence is building, the low volume, the VIX down near support. And all we do is each time we inch up, like I said, the market is just slow grinding higher. And with these divergences and everything else, that just typically the bigger the divergences, the bigger the drop. So where we were at, back here a week or two ago, flirting with 8,200, and I was looking for a drop that was about, at that time 2% to maybe a little bit, about 2% or so. That would be 2.6. Now that my expected drop, when it comes, is now measured out to about as much as 4.25% to what, again, I call my preferred target zone. That's the bottom of that target zone. Runs from about 80.40, 80.50 down to about 79.80. And to really get it going, like I talk about, the selling begin to accelerate, we really, I think, need to take out 8,200. At that point, it should be some, more impulsive selling that can take out in just a day, easily take out this, couple weeks of sideways trading here and wipe out all these gains for the last, that would take us down. The trend line was October. That's early October lows. So we'd have to take out the entire trend line to wipe out, the gains since October. But at this point in time, I'm looking for a level here. And as I said in that post this morning, guys, if you are a dip buyer, and I know there's some out there that are convinced this market's going much higher before it has a decent correction, then each of these levels are support levels, and you could see just like that one where you can go long on if you want to buy the dip. This would be the ideal spot if the charts confirm, maybe fall to this level, get a little near-term selling climax and bullish divergences. But as I said, when we get down there, I'll assess the charts if and when that happens and consider maybe just trailing, lowering stops and letting it ride to see if we can have that false breakout scenario, because still nothing for weeks or months has changed on the daily and longer term. The daily, weekly, and monthly charts still have the same technical posture they did, like I said, back then. And that was NQ. I gave you levels on ES this morning. These are the levels on ES I pointed out, and you can see this morning I had a trend line there on ES, the S&P 500 futures, and that one was taken out too. That was this morning's, posted about an hour or two. A couple hours before the market opened right there. That was your new trend line. This is the primary trend line off the October 3rd lows. And so you're wedging up underneath. You broke down just like NQ, back testing, wedging, and that was then 2 hours before the market opened. This is now, if I can find it down here. I've got so many charts going on. Here it is. All right, and we broke down. So let me zoom in. You can see the entire trend line off the October 3rd lows. We zoom in today, real tight, and that was it. We broke down shortly after that. After that was posted, had the biggest drop right there. You can see this is the biggest drop that we've had. It's not much. Again, S&P was virtually flat today on the day, but this was impulsive selling. It helps to validate. These technicals are playing out. And again, as I showed you, you have those pending a little more downside. You'll get the bearish PPO crossovers on the daily charts. And as I showed you a minute ago, those are corrections that ranged usually about 5, 6, 8% and more throughout the year. So that's what I'm still looking for. And the levels, I have these sort of color coded as I did on NQ. It's really the yellow levels. NQ, I want to see 8,200 go. You have some pretty good support coming up. And so again, if you're a dip buyer, if you're a bull, or if I were, this is where I'd be looking to go long anywhere here, about 3,100, about 30. Yeah, about the 3,100 level. It's close enough. And then you have intersecting trend lines right here, support below, and another pretty big level here. So I'll watch and assess the next pullback as it develops. But I think it would come along something like this. And although I favor a move down here to at least 30.22, that's my minimum target zone. That's why it's colored blue there. And very much open to the possibility and kind of leaning towards right now at this point in time move down to about 30.22 or so, and that would constitute from where we're at right now in the after hours session, that would be a drop of about 3% right there on SPY or the S&P 500 ES. Sorry about that. And finally, the Yeah, I also posted a chart of RTY, the small cap ETF this morning. I just showed you what that looked like a minute ago with IWM on the daily chart. On the 60-minute chart, we have a pretty clean downtrend line here on the 60-minute chart. So I said, most likely scenario, should RTI break out above this minor downtrend line, that would be a marginal new high scenario. You can see looking like this, and with the green arrows, meaning pop, run up there, and any new high soon would be guaranteed to be a divergent high, just based on how these indicators are lagging. And whether we pop that or not, either way, I have us coming down here. If we take out this the 1580-ish level right here, you can see that 1580 level, this line here. That will most likely bring us down here. That was earlier today, and we slightly but unimpulsively popped above it. Let me give you an updated chart of RTY. So this is what RTY looked like today. We went on, it did pop above there, but we failed. So right now, not making too much of this, because again, we're in a low volume, not big price swings. Even these little tiny moves look big because we're in a period of extremely low volatility. But that is a failed breakout. That is a decent trend line. You can see as I come in here and tighten it up a little bit, we have 1, 2, 3, 4, 5. We had 5 distinct reactions before we broke it today, and we're right about on it. So any more downside, it will help to firm up that little potential fake out, false breakout, aka bull trap scenario. But again, my focus remains more so on the large cap. Let's see how those do. I just wanted to update RTY for you small cap traders. And all right, so those are the levels to watch, and like I said, outlook's the same. Members of the site, I'll try to, like I said, get back to any questions, comments, follow-up as soon as possible, and continue to focus our efforts on other things other than the broad market that have much better risk-reward profiles, much more profit potential. We've had individual stocks, biotechs, you name it, going up and down. High, well into the double digits in the last couple of weeks. All different type of sectors or niche things that aren't tied into the broad markets, which have just fallen asleep at the wheel, grinding higher with almost no volatility and very small gains. And but what I will say is that is exactly when the market finally wakes up. It can stay in this sleep mode, this zombie mode, for quite some time, but don't be complacent and be ready to move. If you get those sell signals, like I say, volatility will can very quickly spike up. So if you sit there and watch the market drop 2-3% and then you decide to short, you may have missed most of the move if it's going to be a quick pullback trade. But again, we'll assess any pullback, or the next pullback I should say, if and when it comes, and we'll go from there. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.